A brand new bombshell report reveals how global real estate markets could crash. I'm going to explain this to you in 3 simple, fast steps, and I'm going to tell you how this could impact the United States market more specifically. Step number 1, let's go right over how real estate prior to the GFC was local, but now it's interconnected. It's gone from being local to global. So what this means is there's a lot of systemic risk, just like there's systemic risk in the banking system. Question, what's the largest asset class in the world? That would be real estate. What's the largest real estate market in the world? That would be China. Right now, they're at $42.7 trillion. That's the size of their real estate market. And to give you some context, the United States, 42.1 trillion. So it begs the question, if the United States real estate market crashing can lead to the GFC that we saw in 2008 and 2009, what happens if China's real estate market crashes? Let's get right into a chart going all the way back to 2006 to today's date. We go from 80 up to 360. This is an index going back to 2005. So the United States, we start at 100 and it goes up and up and up. It peaks out at their bubble, 2006, and then as we know, crashes down, bottoms out 2012, has gone up since then. I want to point out this chart is prices in nominal terms. So it is not adjusted for inflation. So when we look at these huge declines in places like Canada, you have to also understand that the decline is even more extreme in terms of purchasing power. So this blue line represents the United States, black line Canada, green line Australia, but red line is what you've really got to focus on. This is China. And we can see that it has gone straight down pretty much since 2020. But one of the shocking discoveries that was made by this report, and it was done, by the way, by my good friend Brent Johnson over at Santiago Capital. We'll put the link to the report in the description below, about 50 pages, and I cannot suggest reading it enough when you got some time over the weekend. But what they do is they go back and analyze what exactly happened with China from 2000 to 2020. We all know the economy boomed, the real estate market just went parabolic. But what was happening with the people that were actually living in China? What were they doing with all of this newfound wealth? Well, they were taking a lot of that wealth and investing it in other geographical locations across the world. They were diversifying their geopolitical risk. That makes sense. So they started investing in markets like the United States. They started investing in markets like Australia and Canada. But what we have to think through is what is happening now in terms of geopolitics. What is happening now in terms of China's economy, and more importantly, China's real estate market. It's going in the opposite direction. So we had all of these tailwinds with the global real estate markets due to the fact that the asset prices were increasing in China, the economy was booming, and we had this move towards globalization. But now, this capital is going in reverse. So instead of flowing out of China, it's most likely going to flow back in. Not because the Chinese want to bring the money back, but it's because they don't have a choice. Let's think about this in terms everybody can relate to. Right now, you're in the United States, most likely, or in the West. So your media that you're watching or reading every single day is heavily biased against China and some other countries out there. Now, I'm not saying that China is some bastion of freedom or a great place. I'll let you be the judge. But we have to understand that the media is spinning everything to make sure that the United States looks like the good guy and everyone else looks like the bad guy. Well, they're doing the exact same thing in China. So, as we see all of these economies and all of these sovereign nations start to pull back, say, okay, we were doing business with the world, but we see the risks involved. So now we're going to start manufacturing everything right here at home, and we're going to start consuming all of the stuff that we make. And these global supply chains that have been created since 2000 are now going the opposite direction. In other words, the global supply chains are now becoming local. Now, there's a lot of trade offs, and I can't go into them in this video, but the main focus is these capital flows are now most likely going to reverse. And the reasons for this reversal don't end just with protectionism. We have to think about this in terms of the asset decline in the overall economy. So, right now, you have a balance sheet. You have some assets and you have some liabilities. Well, let's assume for a moment the economy in the United States starts to decline, just like we're seeing in China. The unemployment rate goes up. Let's say you lose your job. Well, what are you going to do to make sure that you can put food on the table? You're likely going to start selling some assets. Well, for the Chinese, this would mean selling their real estate in Canada, the United States, or Australia. And to take it a step further, we have to realize that the Chinese economy has been built around, revolves around, and is completely dependent upon not just manufacturing, but probably even more so, their real estate bubble. So if China's real estate bubble starts to implode, that could put massive downward pressure on real estate markets across the entire world. But unfortunately, this isn't the only thing that could be putting massive downward pressure on the real estate market right here in the United States. More on that in step number 2. And in step number 3, I'm going to go ahead and give you my prediction as to what I think prices will do in these other markets over the next 3 years. Step number 2. Now let's go over some of the key data points from the United States and one shocking statistic from Australia. We're going to go right over to the report, and it's called Who Gets the House? And this is Brent Johnson's new project called The Macro Alchemist. And it looks like he's partnering with a gentleman by the name of Michael Peregrine. Hopefully, I'm pronouncing that correctly. If I'm not, Michael, I apologize. Let's start by looking under the hood of the U.S. labor market. Now, we hear every single day in the mainstream media that the economy is booming because the unemployment rate is low and the labor market is tight, but that's not the entire story. Check out this chart. This shows us how many multiple job holders there are in the United States going all the way back to 1995. And you see right now, as we speak in 2024, we are at an all time high. And it's not just multiple job holders, because you could be saying to yourself, well, George, well, that's because of the gig economy and that everyone's subsidizing their income by driving Uber or something like that. No, 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 no. Let's look at this next chart, which might be one of the most shocking charts I have seen this year. This shows us how many people in the United States are not just working multiple jobs, but working multiple full time jobs. You heard me correctly. Multiple full time jobs just to make ends meet, because I'm assuming that no one is working multiple full time jobs because they want to. It's because they have to. And this goes all the way back to 1995, like the previous chart. And it just really spiked up with the rate of inflation. It's come down recently slightly, but we are still close to all time highs. And let's remember, this is coming at a time when the price to income ratio is also at all time highs. In fact, notice where the price to income ratio was back in 2006 at the peak of the last bubble, and look at where it is today. The last bubble, we were at roughly 3.5, now 5.21. So that means the average price of a home is over 5 times the average income. This is totally unsustainable. But the pushback that you're always going to receive is, George, well, this time it's different because the supply dynamics are completely changed. There's all time low supply. There's no supply. There's no supply. And there's never, ever, 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 ever going to be any supply because no one is going to sell their house and lose that 3% 30-year fixed rate mortgage when they have to go into, let's say, a 7 or 8% mortgage. Well, in my view, this is a very incomplete analysis because what you're doing is you're just getting hyper focused on the real estate market as if that's the only thing that matters. But most of you watching this video have a lot of great common sense. You're like, wait a minute. If I've got a $2,000 a month mortgage payment and I lose my job, then I can't afford to make that payment regardless of whether or not I have a 30-year fixed rate mortgage at 3%. I'm going to have to sell the house. And it's not just with your job, it's with the price of everything. If your purchasing power is going down for whatever reason, because the stuff that you have to buy daily, let's say, is going up in price a lot faster than your income. Maybe it's your property taxes, maybe your property insurance, your maintenance. It could be the cost of overall home ownership outside of the mortgage. But forget real estate for a moment. People's grocery bills have been going up. Your healthcare costs have been going up. If everything is going up at a lot faster pace than your income, your purchasing power is going to be going down just as if you were losing your job. And at some point, you're not going to be able to make the mortgage payment. And it's going to force you to sell the home, which increases the supply available at a time, which, oh, by the way, demand is at an all time low. But let's get back to the report and look at the next chart, which is employment based recession composite. So this takes 7 data points and combines them into a chart and then shows us how those points in time relate to recessions in the past. So I'm not going to go over all these, but the first data point, just to give you an example of what they look like, new claims for unemployment, 8-week smoothing of 26-week change is greater than 60,000. So you really get into the weeds. So all of these data points are combined into this blue line. And what we see is when the blue line gets above 3, we have always been in a recession or very close to it. And right now, we are at a 6. So I'm no genius when it comes to math, but I do know 6 is a lot higher than 3. There are no certainties, there are only probabilities. But let's assume for a moment we do go into a recession. Is that going to increase or decrease the unemployment rate? Well, obviously, it's going to increase the unemployment rate. People are going to lose their jobs, which again puts more downward pressure on purchasing power. But that's not all. Let's look at credit card delinquency rates. They have been skyrocketing, as you would imagine, since their bottom in 2021, 2022, when everyone was getting the stimmy checks. So we are not at all-time highs yet, but we are heading in that direction, unfortunately. And what's really most striking about this chart is look at the black line, how that's the most extreme. That's what's gone up to the greatest degree. And I say that for me, this is really the key point of this entire chart. Why? Because it's the 18 to 29-year-old age group. Now, a lot of you are probably saying, well, George, well, that makes sense because kids are young, they're irresponsible. This is what you would expect. Well, not really, because what we have to do is we have to go back and look at the wage increases that we have seen since 2020. And the majority of the wage increases have gone to the 16 to 24-year-old age group. And this is per the Atlanta Fed. So their wages have gone up the most. In fact, their wages have gone up a lot more than the rate of inflation. Unfortunately, everyone else's wages, or the people that are out there trying to buy homes, have gone down in relationship to inflation.
But for that lower age group, they have done well and are continuing to do well. So then you have to ask the question, why are the delinquencies on the credit cards going up to such a great degree with this demographic? And I think it gives you insights as to what's really happening in the job market, and more so what's really happening with the underlying economy. But the next chart is the one that completely blew my mind. This is a buy now, pay later popularity diagram, if you want to call it that, or map, I guess. It's a buy now, pay later popularity map of the entire world. Now, the country in the worst position is Australia, but the United States and China are not that far behind. So, what this is doing is it's showing you how many people have utilized a buy now, pay later app or service on their phone or on their computer. Now, it doesn't necessarily mean that they have used buy now, pay later, but it means that they have set up the process to have the ability to use it now or in the future. For Australia, this is 50 to 100,000 people. You say, George, well, that doesn't sound like a lot. No, no, no. That's 50 to 100,000 people per 100,000 people. So that means in Australia, at the very least, 50% of the entire population now has taken proactive measures to have the ability to use buy now, pay later. And in the United States and China, it's not that much better. We go from 15,000 to 50,000. So from 15% to 50% of the entire population. There's over a billion people in China. I want to remind you, they all feel they may have the need now or in the very near future for buy now, pay later. Now, I want to be clear, the insights revealed in this incredible report in and of themselves don't mean there's a 100% guarantee prices come down. What we have to do is we have to take these headwinds into consideration in our overall analysis. The problem with most people that look at the United States real estate market is they totally ignore all these other data points, not just within the United States, but outside of the United States as well. And if the GFC taught us anything about the global economy, it's that it is interconnected. These real estate markets are interconnected, and the banking system is interconnected. So, this means that there is systemic risk with every single asset class around the world that pertains to every single other asset class, and therefore the domestic economies and the global economy. This video is not about doom and gloom. It's about trying to help you make better financial decisions. I always say, burying your head in the sand like an ostrich is a terrible investment strategy. And I think that most of you would agree.
Step number 3. So, what is my prediction for the global real estate markets? Are the prices going to continue to go up and up and up, where we see a bigger and bigger bubble, or are they going to come crashing down? Well, before we get into my base case, let's go over the elephant in the room. And this is the exact same elephant that was in the room in 2007. What I'm referring to specifically is the monetary system, the banking system, the fragility of the global monetary system and the global banks, and how interconnected they are, and all this systemic risk that plays into not just economies, economic growth, and economic contractions, but also asset prices. So here is a massive oversimplification, but it just gives you an idea of what I'm referring to. We've got China, Australia, Canada, US, and then we have the red banks, obviously China, the Canadian banks, the US banks, and the Australian banks. Well, they're all interconnected as far as these balance sheets, not just with one another, but also with the global dealer banks in the Eurodollar system. So what happens is if we get declining asset prices in China, especially in an asset class that is $42.7 trillion, this is going to lead to a lot of problems for the banks in China, which is going to lead to a lot of problems for the banks in Australia, the United States, and Canada, and more importantly, the global dealer banks in the Eurodollar system. So what type of problems could we see? Well, if they have outright defaults, then this is going to blow a hole in the balance sheet of a lot of these banks, and the liability of China banks are likely the assets of Australia, US, and Canada banks, and vice versa. Now you understand what I'm talking about as far as systemic risk, but it doesn't end there. Because let's just say that we don't have a lot of defaults, but what happens to the overall perceived risk in the system? So put yourself in the position of one of these banksters. Let's just say that you run a bank in the United States and a lot of your assets are the liability of Chinese banks, and you know darn well what's happening with their economy and their real estate market. Are you going to be more or less willing to lend to them in the future? Obviously less. Are you going to be more or less willing to lend to other people in the future, other banks, because you know their balance sheets are connected to the Chinese balance sheets as well? You see, so what happens as far as liquidity? It doesn't really revolve around the Fed or the PBOC or a central bank. It really revolves, or regulations for that matter, it really revolves around one thing, and that is risk. If the amount of risk is increasing, the liquidity is going to be going down regardless of what the Fed is doing with quantitative easing, as an example. And if liquidity is going down, in other words, risk is going up, that adds an additional headwind to asset prices, more specifically global real estate markets. Whoa, time out. Before we move any further, I want to give you some specific details as to how impaired a lot of these global banks' balance sheets are right now. So editor, let's throw up that chart from that incredible report from Brent Johnson over at Santiago Capital, and we can see the amount of unrealized losses on banks' balance sheets right now. But what is astonishing is when you compare the unrealized losses today from where they were in the GFC. Right now, the unrealized losses in the banking system dwarf anything we saw during 2008. We have to remember that the GFC back in 2008 and 2009 wasn't really a problem that was exclusive to the US real estate. That was just the straw that broke the camel's back. The main problem was the fragility that we had in the global monetary system, which I would argue is even more fragile in 2024 than it was in 2008. And oh, by the way, this isn't just the opinion of George Gammon. This is the opinion of the entire Treasury market. That's why the yield curve has been inverted for over 2 years. So what is my prediction? Do I think prices will go up or down in the future? That's what everyone wants to know. And like I always say, there are no certainties, there are only probabilities. But we have to assume that in the future, prices will mean revert back to incomes. And I say this because, number one, it makes sense, but also if you look at a chart going all the way back to the 1990s, you see that home prices, when you adjust for inflation, pretty much flat from 1890 all the way to the 1990s. And this, like I said, makes sense because the home prices should just go up with the rate of inflation, because the rate of inflation is pretty much a derivative of incomes, or incomes are a derivative of inflation. So they all should kind of equal out. When we get way above that trend line, you know we're in a bubble and the risk is to the downside. Now I want to go back to that chart that we showed in the report in step number 2, where we see the price to income levels being at extremes, 5.2. So my base case is at some point in time, that will mean revert. Now it has to mean revert one of two ways. Either incomes are going to go up or prices are going to come down. And I'll let you decide which one is most likely. For me, I think the odds favor the prices coming down. But more importantly, what this is all about, when you look at the real estate market or the stock market or really any asset class, is you can't start by asking the question, is the price just going to go up? Well, I think it is, therefore I'm going to buy. Or is the price going to go down? Well, if it is, then I'm going to sell or go short. It's really about asking yourself, what is the risk I am taking for how much or how little reward? I would argue prices can still go up in the United States. I mean, they can go up for the next 20 years. But look at the downside risk. And what is your upside? Let's just assume for a moment you think the upside in the housing market over the next 2 or 3 years is 10%. Okay, fantastic. But you're risking a 50% decline in order to get that 10 or 15% gain. For me, that doesn't make any sense. If you look at all the great investors throughout history, not just in real estate, one thing they all have in common is they make asymmetric bets, meaning their downside is a lot less than their upside. And they always have the probabilities in their favor. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I'll see you on the next video.